This week on Wealth Track, a winning strategy for protecting your portfolio. Morgan Stanley's chief investment strategist, David Darst, a noted master of the art of asset allocation, shows us the plays to keep your portfolio safe. Next time on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. U.S. stocks, particularly large cap ones, are starting to come back in favor after the equivalent of a year-long boycott by many investors. A recent Bloomberg poll of professional investors, analysts, and traders found that 48% of them believe the U.S. will be among the best performing markets this year, the highest rating since the poll began in 2009. And it's more than twice the number who expect China and Brazil's markets to lead the pack. As an asset class, stocks overall are favored as well, with 50% of the surveyed planning to add to stocks over the next 6 months. On the flip side, bonds are expected to be the worst performing major asset class this year, and about 45% are planning to reduce their bond exposure. This is a far cry from investment attitudes last year when stocks were shunned and bonds were embraced. It also would have been a poor strategy to follow. Last year, stocks were the big losers and bonds the winners. But what does this mean for our portfolio longer term? That's where this week's financial thought leader guest comes in. David Darst is chief investment strategist at Morgan Stanley Smith Barney and a noted expert on asset allocation, considered to be one of the most important components of investing. David has written several books on the subject, including Mastering the Art of Asset Allocation and his most recent bestseller, The Little Book That Saves Your Assets, a Wealth Track bookshelf recommendation. As Darst points out, broad diversification can stabilize portfolios even in volatile times. Over the last 10 years, the difference in returns among asset classes has been wide, ranging from compound annual growth rates of a measly 3% for the S&P to nearly 12% for emerging market debt, over 10% for real estate investment trusts, to nearly 19% for Latin American stocks as well as gold. But what Darst believes investors should pay particular attention to is the correlation among different asset classes. In order to manage the risk and reduce the volatility in one's portfolio, he recommends mixing in assets that don't track stocks. Over the last 10 years, they include U.S. Treasuries, managed futures, high-quality corporate bonds, treasury bills, and foreign bonds. I began the interview by asking Darst if we should rethink the central role that stocks have traditionally played in our portfolio.
Well, Consuelo, it's always a good idea to get your bearings, to evaluate your mission, to evaluate the purpose of stocks. Good stocks, good companies really represent human endeavor, human aspiration for a better life. Stocks are basically building on this human desire for an improvement of the planet, emerging markets, population growth. So you want to basically make sure you're choosing the right kinds of stocks that have exposure. We've talked over the years, you and I, you want to have these companies that have good balance sheets, fortress-like balance sheets, good cash positions, phenomenal managements that can basically take what they know and put it into these emerging markets.
The benchmark asset allocation has been traditionally 60-40. That's the starting point. Then what you do is you either ramp up or you ramp down from that kind of starting point. So should stocks still be the predominant asset class in your portfolios?
That's a phenomenal question. Consuelo, because it's going to be affected by, and it's going to be driven by a person's temperament, their age, what are their lifestyle goals, their income needs, what are they going to do with the money, and in the end, is it savings type money that they cannot lose? Is it money that's going to be set aside for children's college or for foundation? So I think stocks deserve a place. They are not an asset that should be totally abandoned. 60% might be high, but it depends on the person. Consuelo Mack, I know 78-year-old people who invest like 18-year-olds, okay, and they can stomach it, and they've got the money that if the portfolio fell 50%, it wouldn't affect them, mentally or lifestyle-wise. I know 18-year-old people who should not be 60 or 80 or 20, 90% in stocks. They should be basically husbanding because they're trying to save a nest egg to do this or that and not risk all of that. So age-driven investing is not appropriate. It's your temperament, it's your tax situation, it's the needs that you have. So 60% is the received wisdom, and we were all taught this like catechism, Consuelo. We were taught this like dogma.
That's what I'm asking you. You are the master of asset allocation, David Darst. The world has changed. We have many more assets to choose from.
Don't we ever?
Many more investment choices to choose from. With all of the asset classes that we do have available to us, what should we expect from stocks versus the other choices that we have?
Consuelo, this is a great point.
It's a fundamental question now.
I think everybody needs to have diversification. Okay, and diversification means asset classes that zig when other asset classes zag.
So let's talk about that, because again, this is all new in the last really 10 years. That we, unless we're a high net worth individual or institution, that we have choices that we never had before. So what are the other asset classes that should be in everyone's portfolio, basically, as a starter?
Consuelo, and I hate to go to a sports analogy, but the world of professional football, they have this saying that offense wins games, defense wins championships, and special teams win Super Bowls. Special teams is the kicking game, it's the punt return game, it's the point after touchdown game. It is all of the other things aside from being on offense or defense, which is very, very important to win championships.
Right, having just seen the Super Bowl, we know what you're talking about. Okay.
Exactly. So what you want to have is some offensive assets, and they tend to be stocks, U.S. stocks, but no longer, as you just said, not only just U.S. stocks. There's Canadian stocks. There's United Kingdom. There's Great
all
Britain.
The emerging market stocks.
And emerging markets.
Right.
You want to have fixed income securities. You want to have bonds. And that's to give some defensive characteristics to the portfolio.
So we just did the offense, which is stocks to win the game. Now you've moved to defense, right?
Defense is to win the championship.
Right.
Listen, when 2008, when the stock market fell 37%, the 10-year Treasury bond went up 20%. Last year, as you know this, 17% gain,
10-year,
total return for the 10-year, and the 34% gain for the 30-year. So you needed to have some of this in there to play defense. Last year was a very volatile year. There were 69 of these big volatile all-or-nothing trading days, as you know, which is more than the total from 1990 through 2004 combined.
Right.
So we had a lot of volatility.
So what is it that wins the Super Bowl? Just explain
Special teams winning the Super Bowl involves the following. People who had a little gold in their portfolios. Back in 2008, when the market in the U.S. went down 37%, emerging markets down 53% or more. Some assets fell 70 and 80%. If you had a little gold, it prevented you from panicking about your good investments. So you said that's the special teams. Special teams is psychological too. So people called me and said, this great big U.S. industrial giant is going out of business, okay? I said, there's no way of that happening. The balance sheet, we've looked at it, everybody says, do you have any gold? Yes, I have a little gold. How's the gold done? Well, we've got a big profit in it. Then don't sell the other one. Use this as a mental offset. It's financial Tylenol. It gives you the calm, the peace of mind you need in times of great market tumult and great market turmoil and turbulence. You need to have the sang-froid, the coldness and the dispassionate ability to see through all this and remain calm. That's what these non-correlated assets like managed futures, which were up 14%, that's the index. in 2008 when the market was down so badly. Gold was up 5.8%. Inflation-protected securities did well. So these things are non-correlated with the stock market, which I know has been a theme that you've emphasized and repeated over and over. You want to have some things that zig when others zag, and that's the special teams aspect. The second big theme is you want to have rebalancing. And that's something we've discussed about.
Let's talk about rebalancing, when you do it, I mean, how you rebalance. Just tell me how that works, how you
There's been great work done by the CFA Institute, the Chartered Financial Analyst Institute.
Right, which you are one.
Yes. And they've basically found that there's no magic bullet. So some people do it by price. When something gets too high, you trim it back. When it gets too low, you buy more. We think you need to have a little leavening in there of human judgment, and it's not always you alone. It might be you asking someone whom you trust, your Uncle Frank, your Aunt Matilda, asking someone whose judgment you trust. Does it make sense? Look, Japan's still down 70% from the peak. It was 38,000. It's 8,000, 9,000 now. So if you rebalanced, you would have been plowing more money into Japan that's been dead for 20 years now. So you need to have an overlay of good judgment and good insight, not clairvoyance, not perfect, but is this thing going to be permanently impaired, which Japan has been for a long time now, or is it a temporal thing that will basically flatten out? So you had the tech stocks in the late 1990s. They got way up, and it was time to trim there. You had the energy stocks.
So let me start with so how do you determine, I mean, aside Japan, of course, in retrospect, we all get. The tech stocks, when suddenly tech stocks are 30% of your portfolio, is that another way to judge it as the position in your portfolio?
You do it by price or by time. You do it by price or by time.
Or by time.
So by time is once a year, you go and look at your allocation, and you say, I'm supposed to be 40% in stocks. I see that stocks have dropped 10%. Now I'm only 36% in stocks. Let's say everything else was the same. That means you take a little bit of that and you put it back into the stocks to bring it back up to 40%. Similarly, bonds, because they've done so well, bonds this past year, with stocks basically flat, bonds have grown to be a part of the portfolio. And many people would say, you know what, you need to force yourself to trim. So it's a little bit like a clock, or it's like the bell tolling, meaning once a year you need to sit down and look carefully at the portfolio. One of the greatest things about rebalancing, there's no magic bullet. There's by time or there's by price.
So it's a discipline.
It's a discipline of making you sit down. My late father-in-law, whom I loved dearly, he would complain about his financial advisor. Thank goodness he was not at our firm. I would not let him be at my firm for family harmony. I would not let him be at our firm. And he would complain, and I said, you know, how often do you go and visit this guy? And he said, I haven't seen him in 15 years. I said, you should go into that office physically once a year, sit down, I don't care, 15 minutes, a half an hour, and talk with him, and also introduce yourself to the manager. Your service improves when the financial advisor knows you know the manager.
Right. So is volatility here to stay, David?
I think volatility is basically driven by technology. It's driven by our institutionalization, perhaps hedge funds, and people who trade rapidly, high-frequency trading, computer-driven trading. So volatility is here, but it can range. Even last year, Consuelo, it ranged for the volatility of the so-called Standard & Poor's. It's called Volatility Index, or VIX for short.
Right.
It ranged between 17 and 44. Now, it's recently been, it's a very big wide range. Now, there's a saying in Chicago by these folks who trade on the futures markets there, who basically look like they're in a time warp of the 70s because they're all walking around on platform shoes and wearing wide ties and big fat lapels. But that's another story. They have a saying called, when the VIX is high, it's time to buy. And so the VIX got up to 38 in many of the crises. The big crisis that we had in September of 08, Lehman Brothers, Fannie Mae, Freddie Mac, AIG, that big crisis, it went up to 80.
Right.
So it would
And
not, it's like everything
When
in
the
life,
VIX is high, it's time to buy.
when the fix is high, it's time to buy. It got to be 80, but you could have still lost a lot of money between September 08 and March of 09, which was when quantitative easing came in. That is, the Fed says we're not going to have any more failures. So there's another one. When the VIX is low, it's time to go slow. And that means when it gets down to 17, everybody's very quiescent. And I think for the most of the viewers, you have to, that's a good time. When VIX is very high or when VIX is very low, it's a good time to reevaluate the portfolio. Have a look at it. Just have a glance at it. The third discipline, so there's diversification, there's rebalancing, and the third one, which is very, very important, is risk management. And many folks, I think part of the reason that stocks have been called into question at the beginning of this, you talked about our stocks, what they used to be. Mm-hmm. Nothing is what it used to be, number one. The end of the world as we know it is not the end of the world. This is the end of the world as we know it. We are moving into a new era. Our children, our grandchildren are going to shock the world. American kids are going to shock the world by all the good things they bring. They're going to bring cures for cancer. They're going to bring alternative energy. They're going to bring this incredible amount of conventional energy. You've got the Utica shale. You've got the Marcellus shale. Mm-hmm. And there's controversy. In a British sense, there's controversy. There's controversy over whether that you can do this drilling and this fracking. But what I'm driving at here is risk management is very important as a discipline. And that means having an adequate amount of cash. Many people say cash is not an asset. I have said for years, cash is an asset. Tell that to the Japanese investor who had his money in cash or her money in cash for the last 20 years. Well, the market's done nothing. It's been fine. So cash, bonds, stocks, alternatives. But part of the risk management is, number one, having good quality assets.
So does quality matter now more than it did in the last year or two?
I think quality matters now because markets don't change when fundamentals change. Markets change when beliefs change. And right now, the past year, this 2011, 2012, have basically been a crisis of confidence, a crisis of faith, a crisis of belief in our leaderships.
So risk management.
And that means that we lack faith, trust, confidence, and right now you need to have more than ever diversification, risk management, which is adequate cash, adequate 2-year bonds.
And what percentage of management assets, of defensive assets, higher than you normally would have?
Yes, we're above normal. We're above normal in cash. We have a little bit extra in cash, a few percent more in cash, a few percent more than normal, Consuelo, in 2-year bonds, which are cash-like.
More, not like 10% more, but a few percent more.
Here's an example. Our managed futures, are cash and our 2-year bonds. If you take the three of those, the normal for those is 11%. Right now, we're 21%. Combined.
Double.
We're double, that's right. So we have 7, 7, and 7. 7% in cash, 7% in 2-year bonds, 7% in managed futures. The normal for that is 3, 3, and 4, 11. So we have this defensiveness, a caution built in because of the dysfunctionality. The policies have not coalesced yet. We haven't gotten enough crisis for people to start shouting, enough is enough, no mas, let's basically pull together. That will happen, but we don't think it'll happen until things perhaps deteriorate further. U.S., Europe, wherever. Secondly is the deceleration in the economies in Europe. They're going to basically, we think, in 2012 be in recession. The United States, we believe, is skirting. It's not in recession yet. The numbers have been pretty good lately. But we think there is a risk of that because you're going to have taxes go up in 2013, end of the Bush era tax cuts, end of the payroll tax holiday, and basically imposition of the Obamacare health. There's a tax going up on that.
Right,
so you'll have our economist Vincent Reinhart. He believes that that'll cost the U.S. GDP, that fiscal pothole. Now, it's possible that Congress could change their minds in an election year. I would hope so. He says it will it will clip the U.S. GDP by 2.5%.
That's
so
huge.
it would have been a 4.5 number. It's going to be more likely, in his opinion, a 1.5 to 2 number kind of thing. He's got 2.2% is his single point estimate, but with downside risks if these things don't come to pass.
Let me ask you about the gorillas that you talk about, these gorilla companies. Which gorilla companies should we own? What kind of gorillas are you talking about?
Well, consumer staples companies is number one. This means Coca-Cola. This means Pepsi. This means Procter & Gamble in the household products area. This means Colgate. This means Nestle. This means McDonald's, believe it or not. Okay, they're making a much more healthy menu, and they have a global footprint.
Global domination, dividends, free cash flow.
Good free cash flow. Mm-hmm. Secondly, you want to have some health care. I think the healthcare stocks got beaten down during the whole Obamacare debate. But they have good dividends. They have very, very strong balance sheets. The pipeline emptied. Now it's refilling as they acquire these biotechnology companies. So there you're talking about Johnson & Johnson. There you're talking about Pfizer. Mm-hmm. There you're talking about Novartis, which is the big Europe-based, Swiss-based giant, which has significant operations in the United States. There you're talking about AstraZeneca. Mm-hmm. There you're talking about GlaxoSmithKline, GSK, in the United Kingdom. Both of those stocks, Consuelo, yield 5.5%. So you want to have some yield in the portfolio and this balance sheet strength and this global footprint. The third area is technology. And there you've got the Apples of the world. There you have the IBMs of the world. There you have the Oracles of the world. Those would be the kinds of companies. Qualcomm, which we've talked about. Qualcomm is basically to the smartphone what Intel was. Qualcomm is to the smartphone what Intel was to the personal computer.
Which is fascinating.
And that means that it's the basic ability of the smartphone to do everything it does for us today.
It's a Qualcomm
That's not a
component.
phone, by the way. That's a computer with a phone attached, Consuelo. Mm-hmm. And a mobile computer, to be exact. So we want to own Qualcomm longer term. We had this big report called the Mobile Internet, which you recall, it's about 2 years old now. It emerges off of every page that you need to have exposure. Just as you had exposure as the PC revolution came up, through Intel, no matter whether it was Apple or IBM or Lenovo or whoever, by owning Intel, you had the processors going into this. And this is similar. The ability of these mobile internet devices to do what they do is enabled by Qualcomm.
Final question. One investment for a long-term diversified portfolio. What is it that we should all own some of in a long-term diversified
Consuelo,
portfolio?
I think a stock that our analysts at Morgan Stanley Smith Barney like a lot, and that I like a lot, is Williams Companies. WMB is the symbol. Now, Williams Companies, as you know, on December 31st of 2011, spun off their energy exploration and production businesses. That's where they go looking for oil and gas. And that's a separate company. This is about a $16 billion market cap company. Sales are about $10 billion a year. They have exposure to this tremendous energy sufficiency of the United States and the infrastructure, the pipelines, the storage, also to some of these fields. They have exposure to this, and it's expected they're gonna invest $8 billion in new equipment between now and 2015 to basically build the highways for this natural gas liquids, NGLs, and crude oil to travel through. The stock yields right now 3.8% is the projected yield for 2012. It's got a very, very strong balance sheet, very, very solid management, and is one of the leading companies in the energy infrastructure. And we think that's going to be a theme that's going to have some consistency, and it's going to have staying power. And so that's why it would be my favorite right now.
David Darst, we've covered a lot of territory as only you can in a short period of time. So thank you, David Darst, so much for being with us.
Thank you for having me, Consuelo.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is consider David Darst's Super Bowl strategy for your portfolio. Darst says there are 3 essential elements. For your offense to move the portfolio forward, you need what he calls the gorilla stocks. dominant global players with great balance sheets and growing dividends. For defense, he recommends high-quality corporate bonds or munis, which will provide support and stability. Darst's third component, the special team of investments, are the non-correlated assets that behave independently from stocks. They are investments that we cover frequently on WealthTrack: cash, short-term U.S. Treasury bonds, TIPS, which are U.S. Treasury inflation-protected securities, and gold. For more sophisticated investors, Darst would also consider carefully selected managed future funds. The football cliche is offense wins games and defense wins championships. In reality, you need both, plus some special elements to win the Super Bowl. It appears the same rules apply to portfolios. I hope you can join us next week. We're going to be talking with financial thought leader, MIT professor, and money manager Andrew Lo about his views on investing in his highly regarded alternative investment mutual funds. If you want to see our WealthTrack interviews ahead of the pack, subscribers can do so 48 hours in advance of the broadcast. To sign up, go to our website, wealthtrack.com. You can also watch previous WealthTracks and find past One Investment and Action Point recommendations. And that concludes this edition of WealthTrack. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.